Ready to pass the CPA exam faster? Visit cpapass.ai, today converting cash basis to accrual basis accounting. Welcome to one of the most heavily tested areas on the CPA exam, converting cash basis financial statements to accrual basis GAAP. While millions of small businesses use special purpose frameworks like cash or tax basis because they are simple, the exam loves to test your ability to bridge the gap between these frameworks. Don't think of cash and accrual as two isolated worlds. Instead, see them as 2 points on a single spectrum. Converting from cash to accrual is all about adjusting for timing differences. By mastering these conversions, you unlock easy points on both the FAR and Reg sections of your exam. A major examiner trap is siloing FAR and Reg concepts. Candidates often assume cash to accrual conversions are only tested in FAR. In reality, these exact mechanics directly impact partnership and individual tax accounting in Reg. To master this overlap, we use the scale or plug method. Think of a balanced scale. On one side, you have your cash transactions. On the other, your accrual balances. Any change in your assets or liabilities acts as a weight that tilts the scale. To balance it, you must plug the difference to adjust your revenue or expenses. Let's look at how this works with actual numbers. Let's convert cash collections to accrual revenue using a concrete numerical example. Suppose a business collects $100,000 in cash. At the beginning of the year, accounts receivable was $10,000, and at the end, it rose to $15,000. Additionally, unearned revenue started at $5,000 and ended at $2,000. Using our scale method, the $5,000 increase in accounts receivable means we earned more than we collected, so we add it. The $3,000 decrease in unearned revenue means we finally earned that cash, so we add that too. Accrual revenue is $108,000. Next, let's convert cash paid for inventory to accrual cost of goods sold. Imagine we paid $50,000 cash for inventory. During the year, our inventory asset increased by $8,000 and our accounts payable liability decreased by $3,000. To find accrual COGS, we must adjust the cash paid. An increase in inventory means we bought more than we sold, so we subtract $8,000. A decrease in accounts payable means we paid off prior debt rather than purchasing new goods, so we subtract $3,000. Our adjusted accrual COGS is $39,000. Always analyze how asset and liability shifts alter your true expense. This systematic approach ensures you never get tripped up by directional changes. Now let's convert cash paid for operating expenses to accrual operating expenses. Suppose we paid $20,000 cash for rent and utilities. During the year, prepaid expenses increased by $2,000 and accrued liabilities increased by $4,000. Let's apply our adjustments. The $2,000 increase in prepaid expenses means we paid cash for future periods, so we subtract it from current expenses. The $4,000 increase in accrued liabilities means we incurred expenses we haven't paid yet, so we add it. Our accrual operating expense is $22,000. This simple logic prevents common exam errors. To wrap up, let's summarize the universal rules of the scale or plug method. And when converting from cash to accrual, always look at the change in the related balance sheet accounts. For assets, an increase is added to revenue or subtracted from expenses, while a decrease is subtracted from revenue or added to expenses. For liabilities, the rules are exactly opposite. Do not memorize these rules blindly, visualize the balance scale, practice these conversions on cpapass.ai to build your speed and accuracy. Mastering this mechanical process guarantees success across both FAIR and Reg. You will easily spot these patterns on exam day.